trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels and Stu. It has been a wild week, some wild markets. Not that they're ever super tame, but a little crazier than normal.
I'd say they were a little crazier. Yeah.
They were absolutely. So today's presentation, this is something that we were touching on in Miami and things that we wanted for our roadshow and talking more about the professional view of trading, limit order books, crowding, things like that. And it's something that we find super interesting. We think that most people don't know about it. So we touched a little bit on it on Q&A on Tuesday, but let's do a coach's corner on it.
Okay.
So our topic for today, what's the dangerous side of the trade?
Yeah, this is a good one.
Kind of a little, again, mysterious question, but if you had to guess, if somebody said, what's the dangerous side of the trade? What comes to mind? So we want you to think about that. We're going to address this when we come back to the end. Hopefully you'll pick up the answers we're going through. So our topic for today, I'm going to call it the dark side of the trade. And again, I call it this because most people don't even think about this or think that it's really something to consider.
Is that like a Pink Floyd reference?
It kind of does sound like it, doesn't it? It sounds like a
Dark side of the moon.
it does.
Trade.
Exactly. Dark side of the trade. So let's start off with the question here. What is the dark side? Well, lots of answers you could have given, but it's not volatility. It's not the market makers. It's not time decay.
It's Goldman Sachs. No, I'm kidding.
Goldman Sachs would be another one that would come up for a lot of people. So what is it? Now, Stu, you actually talk about this a lot, or for giving people a different perspective of understanding strategies. But the dark side of the trade is the trade on the other side.
Oh,
The trader on the other side. And people are going, well, what does that have to do with anything? Has everything
got everything to do with it. Yeah.
once we show you why we're saying that. All right. So here's kind of the setup for it and the way that we think that most traders view the market. And traders think that there can be multiple winners. And they have this view that there is let's call it like a central money pool, like maybe for a lottery, that we can have multiple winners. And the Wall Street is just this ATM in the sky, and as long as everybody identifies the correct pattern or follows the news, gets the volatility levels, they say, oh, we're at a relative high, that now everybody gets paid. And that's a myth, and that's kind of how it's taught. Hey, if you identify these patterns, well, why are you teaching it? Well, if you identify it, you can make money. Well, not so fast. Because again, the market is not set up to be a central prize pool where we can have multiple winners. And that's the big myth that everybody seems to fall into. So before we get into more details, quick reminder, right there, marketrebellion.com/get started. We have all kinds, whole library of videos and articles on topics just like this to help you get a very firm, solid footing in this market, because we've talked about this so many times, Stu. There is so much bad information out there.
Bill, I have a question.
Yeah, fire away.
I think I read somewhere, or I may have heard somewhere, that this is a zero-sum game. So
Correct.
how can everybody win if it's a zero-sum game?
In the trading game, it is zero sum. At the equity level for the stock owners, it is not, because you don't need a short position to create a long.
Right.
That's just equity, which we've talked about that recently too. That's
Yeah.
why nothing can outrun the stock. Everything is ultimately tied to the stock. But at the trading level, the only way that you can buy, let's say, a May $100 call is because somebody sold the May $100.
Wait a minute. Are you kidding me? Somebody has to sell it to me?
Somebody has to sell it to you.
So that means if I pay, that means if I pay $5 for it and it goes to 7 and I make $2, you trying to tell me that somebody has to lose $2?
Lost $2. Yep. In fact, their credit came from your debit. A lot of people say, oh, the broker just paid me a credit, or the OCC paid. Nope. Trader on the other side is the one who paid the debit, is where that credit's coming from. They're just
now, look, everyone, I'm kind of being facetious here, right? It doesn't come directly from the whoever sold it to you, or everything goes through
figuratively.
It's figuratively, yeah. But it often it often helps to think about what's going on the other side. It gives you perspective on what it is that you're doing, and maybe you want to do more, maybe you want to do less, or maybe you're in the wrong spot. Like, would you sell it? Would you buy it? It's a good exercise to kind of grab hold of, to have that conversation with yourself.
Very, very good. Yep. So that is true when it comes to derivatives, that every long has a short. That's the only way that they can get created. So again, it's very different for the equity market. We can have lots of people who own shares. You might have a handful of shorts, but if the stock goes up $1, far more people made than lost. But that is not true when we're talking about futures and options and all other kinds of derivatives. So it's very much like a bet. If we bet on a football game, it's not like there's a whole pile of bets at a shopping mall, and you just get to pull one off the shelf and say, that everybody wants to be a buyer. The only way they get created is because you have a buyer and a seller. And so that becomes really important. It's something, again, that most traders overlook when they say, oh, everybody teaches if you see a head and shoulders, here's how you identify it. If we get it right, then everybody wins. And that is not true. And we're going to show you why. So the only way to make a gain is if another trader takes a loss. So there's a fixed supply of money, at least for any given trade, and all it does is it gets shuffled. So one of the things that we like to teach is we'll say that Wall Street or trading is really a bunch of ledgers, that the risk never goes away. It just gets shuffled around. It's a question of who holds it. And that's another insight with the options, that they are tools for adjusting or for transferring risk or for accepting risk. The only way that you can transfer it is because somebody is accepting it.
Bill, what was that line
in Wall Street? On the other side.
Remember that line in Wall Street?
Yeah.
Wealth doesn't get created.
Money itself is never lost. Money itself is never lost or made. It's simply transferred from one perception to another.
Exactly.
Love that.
And by the way, everyone, we're not really, this discussion is taking out any hedges you may have on a trade. Like, we understand if you sell a call, you may buy the stock and create the buy rate, and but that we're not talking about the hedges. We're just talking about the option itself.
But even then, you still have to have somebody on the other side.
You do have to have somebody on the other side, but when you net them together and you start trading the stock, at certain levels, that particular seller is going to be different than where that person trades at, in or out, and it gets very messy to try and measure that.
Yep.
Just
Yep,
wanted to be clear
it
that we're
definitely
just
does.
really just, talking about the option itself.
Yep. So the thing that we want, this is really one of the crux of the idea here in the presentation. Early traders get good prices. Now, again, the big myth, and it's a very subtle shift in your thinking, but again, everybody says, oh, if I see the head and shoulders, everybody gets in, everybody gets rewarded. And Wall Street does not reward you for identifying pictures. It's not an art contest. It's the people who get in early. Now, the reason we say that is that as trades get crowded, prices rise. What else happens? We get imbalances in the order book. Some orders don't get filled. Lots of things happen. We have to somehow balance the markets. And if everybody's
Yeah.
on the buy side because everybody recognizes this, let's call it I'm just going to pick on head and shoulders today. Everybody recognizes it. Well, we need somebody on the other side. If everybody wants to buy, you can't have everybody buying. There has to be sellers. So the only way that you balance that is to have, at a minimum, the prices rise. But again, there's other things that go on with the limit order books. So the payoff depends on the crowd imbalance. Another important point. It is not everybody who identified the pattern or that everybody, hey, I heard that earnings are going to be good, so everybody buys and everybody makes money. That's how most traders treat this, that it's this big centralized pool, big ATM hanging over Wall Street, and it just dumps money. You got the correct winning numbers, and everybody gets rewarded. That is not true. So what you have to do, you have to be on the less crowded side of the trade. Because what happens is otherwise, all of the other buyers become what? Liquidity for everybody else. That's what happened. That's why it becomes dangerous if you're reacting or reacting late. Now, of course, everybody says, "Oh, well, I react early," but remember, everybody thinks that.
Well,
Everybody thinks that, and
let's talk
Wall
about that for
Street
a
deals
second.
in nanoseconds.
All the
Yep.
other all the early, what'd you say, Bill? All the other buyers become liquidity for the rest of the
Oh,
people, right?
liquidity for the
So,
people that
so
went
what does
early.
that mean,
Sure.
everyone? That means that the early buyers are a buyer at a lower level. That's why they're early,
Yep.
and the asset goes up in price. And now
Yep.
people that are coming in later are now buying it at the higher price. And who are they buying it from? They're buying from the buyers that got in at the earlier price.
They got in early. They just become a liquidity pool
Yeah.
for those early buyers. And that's why a lot of times people say, well, I identified the picture and I bought it here and I didn't make any money. What happened? And it's not a question of identifying the pattern, it's being in early. So, to make this demonstration, there's a very cool game, little trading game we can do. And just to simplify it, this is one that we wanted to do, and will do in our road shows, but it would really be fun to do with a live class. But you can kind of do it as a thought experiment. Let's just say we have 100 people in the room, each with $10. So we got $1,000 total in the room. Now the
Mhm.
first thing is it's a conservation law. We don't have new money entering. Once we have $1,000 in the room, the only amount we can ever have is 1,000. That's it. It's got a balance. Again, it's a ledger. So we're going to play several rounds. We're just going to do a couple here for the class, but let's just say that we were to do lots and lots of rounds. So here's the way that it works. Each round, so again, you're sitting in this crowd of 100 people. Everybody pulls out a piece of paper and they write down either A or B. Now, the reason I used A or B sometimes in this game, it's kind of a classic one in theoretical economics and finance, where they might say red candle or green candle or up or down. The reason I don't like to do that is then people say, but if I had the chart, I would know how to answer. See, now we step back into that psychology. I want to strip that out. It's as generic as it can get, A or B. So if you're wondering, well, how would I know? The answer is you don't.
You
You're
don't.
just
Yeah, you
picking
don't.
A or B. All right, at least for this game. Now, the less crowded side, and I'll define what that means in a moment, earns $1 from the crowded side. In other words, the crowded side becomes liquidity for the others to exit. All right, so a little mysterious here. Let's do an example. Round one, let's say that we all turn over our pieces of paper and we announce what were the numbers. And we find out that 60 traders, 60 people in the room chose A and 40 chose B. So who's the heavy side of the trade? A.
A.
These are the people that effectively got in late, right? Oh, I saw that pattern. Oh, I saw it yesterday. Everybody's getting in. Yeah, but you got in late. So now the rule says that everybody on this side, on the heavy side, owes $1. So they owe $60, $1 from each trader, gets shuffled over here. So this side receives $60 or $1.50 each. Now remember, each person started out with 10, so how much does each person in group A have, or that chose A? They have 9, right? They started with 10, they had to pay $1. And what do these people have? They started with 10, they just collected $1.50. They have $11.50. So A has $540 at 60 people that now have 9. And we have 40 people over here that have $11.50, that is $460. So notice that those two numbers total up to 1,000. And that will always be true. It has to be true because it's a fixed number of dollars, at least for any given round. It's got to stay the same. And so just depends on how far you want to take it out in the market on any given time. There's a fixed number of dollars in there. All it does, it gets shuffled. So now here's where things get even more interesting. So traders that chose A are going to be thinking, well, that really stinks. We just lost money. So what do we have to do next time, Stu?
Be on the other side.
We got to be on the other side. Hey, I got a brilliant idea. But wait a minute. How do you get to the other side? The problem is that everybody figures that out and everybody tries to, every trade tries to be on the light side. But in doing so, that makes you now the heavy side. See, now it becomes the whole problem now, and this is one of the things that we've talked about so many times that I know a lot of people doubt, but this is why we say that everything ultimately just regresses into randomness. And because the thinking regresses into an infinite loop of, well, I think that everybody else thinks it's going to be A. Or I think that everybody else thinks that everybody else thinks it's going to be A. Do you want to stop there? Or I think that everybody else thinks that everybody else thinks that everybody else thinks. That might be 3 or 4 levels down. Where do you stop? Where do you think that everybody will stop? See, it just becomes, I don't know. So think about it. If we were playing this game and you just lost $1 because you chose A, what do you do for the next round? Do you stick with A? Is everybody now going to shift to the light side, or is it going to be a contrarian indicator? What do you? And if it turns out to be a pattern where A is always the light side, what happens to patterns?
Goes the other. It'll eventually go to the other side.
It's a very simple way to show it can't exactly, and yet people keep saying, well, you know, it's always happened that this pattern always, that cannot be true. When you hear claims like that, it sounds true because they will select the ones where it works and they'll just casually ignore the ones where it doesn't. And they'll just, well, it doesn't work all the time, but look at this, it worked beautifully. And then people go, wow, that's amazing, it works, it's a crystal ball. No, it's not. It's a selection bias. It's a confirmation bias. They're only looking at the ones that work. So this is why everything ultimately collapses into randomness. We don't know. Where is the light side going to be? Now, maybe we say, you know, it's when, picking on my head and shoulders here, when it breaks the neckline, that becomes the rule. Well, what are you going to start doing now, Stu? Maybe we should front run it a little bit. Well, where do we front run it? 10 cents before? 50 cents before? If I think you're going to front run it by 10 cents, I'm going to do it by 20 cents. And now you're going to think, well, I must know that as well. So now you're going to try to front run it by 30 cents. That's the whole point. Once you understand it's a competitive adaptive system, the market, you can't say here is a rule, i.e. watch this head and shoulders or this moving average or whenever this happens that X has to follow. That is not true. And when people point to saying, here is a case where it worked, fine. Happens all the time. Those are very, very easy to test. And we've done it many, many times at the academic levels. And so has every university at every corner of the world done tests like this. And if you set it up as a specific test, when it breaks the neckline, it's going to this level or it's going down to this level. Spell it out. Not, well, it sometimes moves and sometimes it works and it's sometimes around this. You can't test that.
Bill, you know
But
what
if
the
you want
funny
to put it to
part,
the test,
you know what the funny
uh-huh.
part is here is it's like, let's just say you did everything right and
Yep.
you front ran the entire world and you got out of some position, some long delta position that you had, and the
Yep.
neckline, we'll use the neckline deal. The neckline breaks, and you're oh my God, I'm a genius. Look how much money I saved.
Yep.
And then eventually, this is the whole time thing, right? Eventually, stock finds a bottom, the market
Yep.
finds bottom, and it turns around and kind of goes the other way. It kind of goes the other way. It
Yep.
does go the other way. And
Yep.
now the level that you got out is behind you, right?
It's
Because now the
behind you.
stock is up higher. You got out down here. And for that little bit of whatever room that was, yeah, you saved a bunch of money, but now you don't get to make the big money because you got out back here. And then the argument is, yeah, but
It's
I could have got back in. Well, would you have
ex-
gotten back in? And at what level would you see? There's all kinds of
exactly.
psychology going on here. Well,
Oh, it's
I sold
totally.
it
It's
at
always.
I sold it at 39 on the stock and it went down to
Yep.
32. Oh, if I only bought it at 32, you're not buying it at 32, right? Maybe you go
No.
bid 32 and you miss it, right? Because it trades down to
And you
33
miss it.
and you missed it,
Or you
right?
bid 32 and it goes to 28. Right. And
Yeah,
now you're filled at 32.
now
Right.
you're filled at 32 and now you bail at 28. That happens all the time too.
Yep.
And then it goes back to and then you miss it at 32 and then it goes to 36 and you say, "Well, it gapped, so it has to fill the gap, so I'll just wait it out." And guess what happens? It doesn't fill the gap, right? Now it's trading at
Continues
42
to run like the wind.
and you
Yep.
can't and you say now your ego gets in the way. Well, I can't buy it at 30, I can't buy it at 42 because I sold it at 39. I'll wait. And before you know it, maybe a year later or whatever, the
50,
stock is now
60, 80,
trading at
100.
80. And you missed
Yep.
the
Gone.
wealth. See, you got to save a few bucks, or maybe you made a $2 or $3 or 300% or
Quick trade. Yeah.
79%,
Yeah.
and you missed the real money. You missed you
Yep.
missed a run on the stock where it doubled and
Yeah.
tripled and quadrupled, and there was thousands or tens of thousands of dollars that you kind of left on the table because you were so happy that you got to save yourself $500. It's insane.
Yeah. Or Nvidia
It's,
a few years ago when it went from 100 to 700 and people
yeah.
were thinking, oh, I bought this option for 5 and sold it for 7. What a great trade. Well, all right. Just keep doing it. You're going to find out that when it ultimately collapses into randomness, which it must. Now, this is also where a lot of traders say that's nonsense because people don't wake up and just start flipping quarters to decide to buy and sell. We're not saying that they do. They can have very specific intentions, but when you have millions of people doing it at different times, slightly different times, for slightly different reasons, it ends up looking like randomness. And that's really the whole point. So if you think that you can just follow these rules and get in, it's not going to work. And at a minimum, the thing that everybody overlooks is because they end up being on the heavy side. So let's look at like some common signals. So be cautious of using common signals. You have many traders are watching and reacting. So we know what those signals are, right? There's a million of them. Every indicator is that's what it's doing. It's trying to
It's a
give you
signal. Yeah.
some type of a signal. They're all some type of a
It's the 913 or the 813 crossover.
that's become a popular one
It's the
lately,
break
right?
of the 16 and a half minute exponential moving average. It's
Right.
the
Right.
histogram on the MACD, ticking one level of red, less red
Right.
up. It just goes
Those are
on
all
forever.
signals that give you psychological comfort, but people aren't realizing Well, where did you learn that rule? Oh, it's in hundreds of trading books. It must be gold. It's all over YouTube. Think about it. If that's true, you're far more likely to be on the heavy side because everybody's following it. That's the real problem with trying to follow these rules. And I did an upcoming podcast. It hasn't been released yet, but the closing line that I put in there is that if you're not sure which side you're on, check your account balance because it's an unbiased witness, and that will tell you which side of the trade that you're on.
What's
So
that line
again,
in
you're more
poker,
likely to
Bill?
end up.
Bill, what's that
Oh
line in
yeah, if you don't
poker?
know who the sucker is, it's you.
It's you. Yeah, there you go.
It's same thing.
Yeah.
Exactly right. So that's really something we just wanted to point out to people is that it's not enough, even though that's what most traders tend to allude to, say, well, all you have to do is learn this pattern. Here's this pattern. And they make it sound like everybody who identifies this pattern gets rewarded. That is a severe misperception. It's dangerous because only the people who are on the light side of the trade are the ones who get rewarded. Now the question is, where's the light side? Think about it like with that game. You don't really know. And that's what makes it very dangerous to say, I'm going to follow these signals and hope to make all kinds of money. So we hope that gives you some good stuff to think about. That's ultimately what this is about. So what's the dangerous side of the trade, everyone? It is the crowded
Heavy
side. It's the
side.
heavy side. And that's the thing that Stu and I always think about as opposed to, hey, is this signal good? Well, we know that everybody sees it. Everybody knows it. That's why it's a popular signal.
We've been
If
kind of
nobody
seeing
knows it,
that. Bill, haven't we
if
been seeing that recently with
yeah,
what's been the heavy side for the last 6 months to a year, right? The tech stocks,
yeah.
maybe a couple years, right? A year or so. I mean, that's been that became the heavy
Well, that was
side.
actually that's more of a heavy sector, but we're even talking about per trade
Yeah,
that that
yeah.
that
I'm
you
looking at the
have
bigger
to.
picture here,
Yeah,
right?
but one of the
And
things that Stu and I always try to look at is instead of saying, what's the signal? If everybody knows it, we probably don't want to follow it. If nobody knows it, then nobody's going to follow it. But what we always say is, what's the crowded side? Where are most people going to be entering? And is that where we're entering now? And if you're more likely on the crowded side, that can be a very good clue. It's probably not a good trade, even though the picture tells you that it is.
look,
So
even still, it might turn out to be still a good
it
trade,
can turn out to be. Yep,
but what it's just creating more risk for you.
that's right.
Right. And more risk could turn out to be a lot more money, or it can be a lot less money, right? You don't really know the outcome. What I was saying
That's
before
right.
was about like, that whole tech sector, like, which is the first one to kind of roll over, right? The big winner. That's the
Yeah,
heavy
that's right.
side, right? You
Yep.
see, you see stocks like Micron and Microsoft took this big hit, all of them, right? I mean, they're down
Hmm.
yesterday. I think Micron was down 32 points or some crazy number, right? Microsoft is down a lot.
Oh yeah,
A lot of these stocks are off their highs,
I
right?
know.
They became the heavy trade
Yep,
as time went on. Everybody was like shuffling in, shuffling in, shuffling in, right?
that's right. That all that has to go somewhere. It has to reside on somebody's balance sheet. So that's I think we've talked about that before, but remember that risk migrates. You don't eliminate it. It's still there, still the same stock market. It's a question of who's holding it.
Where is it? Yeah.
And where is it, right? Not let's get rid of it. So at any rate, just kind of think about that. Think about that little trading game, play it around a little bit in your head, and you'll start to see that it becomes a very good question, not just about is the picture or the rule correct? Am I possibly stepping into the crowded side? And that'll help you out a lot. So we hope that gives you some good things to think about, some food for thought. And with that, have a great rest of the day. We'll see many of you in Q&A, and if not, we'll see you next week for Coach's Corner.